welcome. You're watching the New Year special edition of Market Masters. I'm Siddharth Zarabi and with me my colleague Sakshi Batra. This is the first edition of our Market Masters series in 2024. And who would be better than Samir Arora, one of the biggest and best known persons in the financial sector and the investment space, founder and fund manager at Helios Capital. Welcome to the show, Samir. Very happy New Year to you. And I want to begin by asking you about something that you had written and said almost 10 years ago in 2013, where you wrote that many influencers were writing about investing in stocks of companies rather than products. And one of the catchy headlines that struck my eye that you had written was, "Do not invest in Indian equities." That was tongue-in-cheek advice at that stage when retail investment was at a not happening in the Indian market. But now retail investors are driving such volumes. What would you advise retail investors in 2024, Samir?
So I would say the same thing that I was saying then, except that I twisted it just to irritate them a little bit that they were making a mistake by not investing. But now that they are investing, which means they have over time got the message. Of course, it was driven also by demonetization, I think, where people discovered the love for financial assets, or maybe they had no other choice or less choices after that. But now the advice is what it was there, except it sets differently, which is that equities normally give the best returns over the long run as compared to other assets like land or gold or bonds. Sometimes in land you might make more because you bought unconverted land and then you were a developer, so you made more. But for normal people buying any of real estate, you would do better in equities over time. It is more tax efficient. It is less costly to manage it, to look after it, to pass it on. From every angle, equity is a good asset.
Since you mentioned the word mistake, given the valuations that we are seeing in the market and, record highs, are retail investors specifically staring at any possible mistakes that they should avoid in your view?
Oh, they are making one mistake. First is to project what they have done in the last 2-3 years as that is normal expected returns from the market. Basically, if you look at any broadly longer term period, even 5 years, 10 years, 15 years, 20 years, 25 years, we've done all of them. Basically, the market index level will give around 15%, 14% in INR terms. Therefore, collectively, all the investors together cannot make more than this because they all together are the market. So for everybody to claim that he is wanting to make 25 or 30%, or because that has happened for the last 2-3 years, annualized, actually didn't happen last year, but mostly in 20 and 21, and then in 23, that is the normal, it is not. The second mistake being made is to think that because there are so much flows from domestic investors and foreign investors, therefore the market cannot correct. That also we have seen over time, these things don't matter. What matters in the end is if the valuations are extreme, then you have to be careful. And it is surprising definitely to see inflows into small cap funds and mid cap funds being nearly the same as in large cap funds, or much more in terms of flows, but nearly the same in stock. It is just unreasonable, and that is a mistake they are making. But we all have made mistakes in the past, and everybody makes their own mistakes. They don't want to learn from others. So it is part and parcel of paying for your education.
Well, good afternoon, Samir, and Happy New Year to you. We had a bumper year, when it comes to equities in 2023. I think the question that everybody has is that will we see a repeat this year? Will the party continue on D Street? What's your own sense? Or are you feeling a little bit nervous or giddish at these dizzying heights that we are at in the market?
So the thing is that if you say repeat, then we can easily say no. Repeat is because one of the extreme years. But the point is, we don't need that kind of a year to justify investing in equities. Broadly over time, you are going to make 13, 15%. And that is itself a good enough number. If you make too much more than that, then in the next year or year after that, you'll have to give up. That I am totally convinced. Because at the end of the day, the earnings and price appreciation have to be more or less similar or nearly exactly the same actually. For example, I can simply prove to you that arithmetically that they follow literally. So for example, let's say P today is some 22, 23, whatever you want to take it, say 22P. And then you say, when was it last 22P? So let's say in 2006 end or 7 and it was 22. That means from that day to today, whenever it was last 22 or whatever is the P today, whenever it was last the same number, then between these two periods, the price and earnings have to move 1:1. Otherwise, you cannot get back the same P arithmetically. Broadly, it means that you can't keep making money out of saying now that 22 has become 25, that 25 has become 30, the P earning multiple. Therefore, over time, prices and earnings have to be similar. And the earnings don't go up and down as much as markets do. Earnings over time will grow in line with GDP growth or in line with corporate earnings growth or whatever. And that broadly over time at a market aggregate level has been in this range of 13, 14, 15%. You can see that in financial sector broadly, in IT sector broadly, in consumer sector broadly, that they all grow within mid-teen. And then some companies grow much faster and then some other companies are doing badly and overall it evens out. So you can't get much more than that. And these are the mistakes they are making in thinking that you can have very high returns. And secondly, that nobody can stop us because we as in retail are coming in. We are very grateful to them. Our business is centered on that, but we have to be realistic.
Be realistic and don't be greedy. That's the point you're making. I'm going to borrow from your investment approach, which you've shared with everyone. And this is to the point about identifying good companies ahead of time, with the tweak that given where valuations are, how does one approach the task of identifying a good company which will obviously be at a lower valuation currently and give high returns?
So first thing is, according to us, you cannot identify good companies and advance as in real advance, as in like people say, buy good companies and hold them for 20 years. But you don't know what will happen in 20 years. The number of companies that do well in 20 years are very few. And the reason you can't do it because the managements and the owners of those companies also don't know that they will turn out to be so good. Just look at your classmates in school. You spend 10 years, I don't know, whatever number of years in class with them in school. Can you figure out that who will be a winner when they all graduate and after that they'll do college, but you may all be in different places. But can you figure out in school that who will be the most successful guy? Nobody knows. You can't figure out for the topper and you can't figure out for the last guy that I will, not bet on him because we have seen all kinds from our own classes. So if you can't figure out for people you've spent years with, you think that looking at an interview or a YouTube interview will start betting on managements, which is what is called halo effect. If something is done well, we will call them good management. If the company stock is doing badly, we will say these guys are thieves. So the only way to do it is to, on a stock basis, not just on management basis, broadly agree that the market is going up some X%, which let's say is 15. Therefore, many companies will go up more than 15 and many will go up less than 15 in terms of stock price because some will be on the way run into issues like bad management or that they will be in a bad industry which cannot sustain those growth rates or they'll be very expensive. So even if the earnings grow, they will not be able to have stock price appreciation or their results will be actually not 15% for their own specific reasons. And so our formula is that you first weed out the bad. Do not buy bad themes where you feel that these things are not sustainable beyond 1 or 2 years, where generally the businesses are very competitive, like it was for telecom for 6-7 years, where you might know that in the end Bharti was going to be the winner, but for 6 years everybody was fighting with everybody, and you wasted 6 years waiting for that winner to emerge. Or if something is too expensive, you can see it in so many stocks whose names I don't want to give you. But if you see last 2 years, there are many stocks where actually earnings have done well, but the stock prices have not moved because they were just too high for those kind of growth rates. So just eliminate the bad. Good, you also don't know beyond a point how good the good shall be, except that you can more easily eliminate bad because bad needs one life. So, for example, if I say a company is very expensive, if I say really expensive, let's say, okay, whatever, you don't need to know other things. But if I say it's not expensive, how does it help? Then you'll say, but what is the business? But if I say this company, I know the management quality is really poor, that is the end of the discussion of that company. But if I say the management of this company is okay, then it doesn't mean anything. There is no actionable step. But what does it do? What is its valuation? So the thing about bad is that you can eliminate it with one factor. For example, if we say an employee steals money, he's bad. If he doesn't steal money, there's no value to that, our employee doesn't steal money. And therefore, in the end, it's the same thing. There are 500 companies, you want to buy 40. Either you can start to buy 40, which you don't know, the management doesn't know, the environment doesn't know, or you remove some 200 bad companies. And from the balance 200-300, you try and make your thing, but be diversified, knowing that basically half the market beats the market. It's arithmetic. It's not 10 companies. It's half the market beats the market.
Wow. On that note, tell us, any particular themes or mega trends that you're watching out for in 2024, any sectoral outperformers?
So we start with underperformers. So right now we think that the shorter term underperformers, because we've already been behaving like this for the last 1.5 years, is the IT sector.
Yeah.
We think that the IT sector, the earnings are not coming through, but the stock prices, particularly in 23, have done well, not reflecting the underlying issues. Although in 22 they had fallen a lot, or fallen reasonably well as far as we were concerned. But over time, if you see, let's say in the financial sector, where the managements are talking about earnings growth, and you know that broadly these earnings growth will come, but the stock prices are not going up, as compared to some other sectors where the managements are guiding down, they are not hiring, they are not meeting even their commitments of campus hiring, and still the stock prices are going up on the basis that in 24 the US market will have interest rate cuts, whereas the management themselves are showing their hand by not even honoring their campus hiring commitments and stuff like that. So we feel that it's very easy between financials, consumer and IT, which are the main three big pillars in our market, that the financials will do better. But let's see if it does or not. Last year it didn't, but we managed to beat the market because of some other mid-cap type stocks or these Zomato kind stocks that ended up doing much better for us.
Yeah.
And even if we had bought IT instead.
So financials, consumer and IT.
No, out of financials, consumer, IT, we are most overweight on financials and we are most underweight on IT. So I'm saying in these three, which are the main three pillars, it's easy to differentiate saying financials is number one, consumer is two, and IT is three. Because you are asking about which sectors will outperform other sectors. That's our view.
Samir, you spoke about the US and I want you to reflect on that and tell our viewers what's your own reading of how the broader macro environment will play out and how that is likely to impact Indian markets. And I'm not even bringing up the fact that this year there are likely to be around 50 elections all over the world, including in the United States and India. But specifically, what's your own reading?
So the elections in India are not, actually that's a positive or at least neutral, because everybody is assuming that the BJP will come in, and that is a fair assumption, not some guesswork. So that is not a negative in any way. So in India, the only issue can be that the excitement is too high, even for us. Our nets are high, we are getting flows in all our funds. And then normally there is some nervousness because twice has happened. In 99 also the same excitement was there, and the similar thing was in 2007. So therefore you just hope that nothing goes wrong on some other ground. But otherwise India is a huge beneficiary this year of the fact that A, India is doing well, and B, that China is doing very miserably. and our biggest competitor for flows is China, because mostly we are both getting money from emerging market investors, and for them China, India, and then Korea, Taiwan, and all are the big markets. And if they have even slight frustration with China, and I think it is more than slight, then India is a huge beneficiary because of China, but also because separately India is doing well. It's not just that, oh, we are the best of the bad or something. We are doing well on our own. And that just pushes more people to allocate a little bit more to India. And for us, a little bit more is good because, China's weight is 30%, ours is 15% in that index. So even if they reduce 4-5% from China, I think they can reduce much more. Half of that coming to India for us is like 20% growth in flows, which is good enough.
That's great. Let's start off with our viewer questions also, Samir, at this point in time. So the first question coming your way is from New Delhi, from Sahil Chopra. And Sahil wants to know from you, what are the key risks that the markets currently face at these record levels?
So market, the key risk is of overexcitement over this thing, because something goes wrong. For example, the government may decide one day that the speculation in our market is too high. It can do that. It has done that in the past when they used to increase margins and stuff like that to discourage the extent of speculation that is happening. Now, how do we say that there is speculation? How is it obvious that there is some? Is that you can see that in the IPO subscription, you can see that in flows into small cap fund, you can see that into the ratio of cash trades into futures trades. Now you may say, why will the government or regulator suddenly want to clamp it down? Because they all fear that if you don't bring it in control, that in the end, this might go beyond limit and then the fall will be even more. Because there is no way you can escape from a fall if you speculate the way that we are speculating. That I think is clear. It's just that you have to, in those parts of the market where there is a clear bubble emerging, you have to control it so that slowly that air comes out rather than it bursting on your face one day. So it can be an easy source of worry that suddenly you tighten some rules, you increase the margins, you massively bring down these speculation, because that speculation coming down means so many market related stocks are going up or have gone up a lot on the basis that so many more investors will come, so many more IPOs will happen, so many more demat accounts will open, so much more futures trading will be done. Even we own one or two of them. But I'm just saying that easily it can be a risk. Broad in
Samir,
the short and this thing intentions.
Samir, we have several other viewer questions, and I'll try and take one of them quickly. Dheeraj Sharma from Noida is asking, should one buy the dip if a correction happens?
Well, the first thing is these things depend on what you have already done. If you are a regular investor and you are already investing and have a sufficient amount invested, these small dips won't matter. If somebody is coming out and saying, I want to start, and for a psychological reason, you may say, invest a little bit now and the rest if there is a dip. Normally, the thing is that these dips will be irrelevant in a slightly longer period. And if you are already investing on a regular basis and already have a decent amount, I sometimes say, because you need to be in control all the time. Even if you have 10% cash, these things don't change your life in terms of returns, but you feel you are in more control and therefore you're willing to stay in longer because you say, I have this 10% cash, I will wait for a better price. So at least you don't redeem what you have already invested. It depends on where you are, but broadly investing in markets will pay off over time, if not immediately. So therefore, in the end, you are a winner by investing in markets. And therefore, in that sense, yes.
Samir, one more question. I think you briefly talked about Zomato, which is also a stock in your fund as well, the Flexi Cap fund, and you also have Paytm as a holding there. And this question is related to the new age tech stocks. This is from Bengaluru, and Revant S wants to know from you, will new age tech stocks perform well in 2024? Very valid question, because at this point in time, we are looking at brokerage houses raising targets for Zomato. It's already doubled in 2023. Paytm is still sluggish because of the regulatory clampdowns. What would your thought be on the entire space?
So for us, because we already have shown you that we own both Of course, we bought Zomato very early at some 52 rupees. But of course, in a new fund, it was bought at the new price. This was in the older funds that were there. And same thing, Paytm, we bought at first time 520, but a new fund which starts in November, bought it at November price. But both we like. Now, I won't call this new age tech in the sense, of course, these are new age, but I don't know which others we're talking, and we don't have a strong view on others, but both these we like. So Marto clearly is doing very well in its execution and in both its businesses. And Paytm, actually, I like, and I feel that they're stopping this funding of below 50,000 rupee loans or offering them to their partners was actually a proactive and a preemptive move. I hope they can show in the results that their own portfolio was not affected. So you're better with somebody who says, this is risky. And the government is also saying it's risky, but I also agree that, or even if I don't agree, I am withdrawing from that. Unlike some other financial guys who might say, no, nobody has told us in black and white to stop. And if we stop it, our growth rate will fall. So we'll continue to do it, which is what normally happens. For example, everybody can see that futures trading, the volumes are too high, but no broker is saying, I'm going to discourage people from doing it or not even do it. So I don't know why people took it so negatively. Okay, it was a bit negative for you to change the growth rates a little bit, but to make it look that it was all their fault, I think it was a bit too much. The fall in December was a bit too much, I think, and we own the stock. So therefore, I'm saying I am biased.
Samir, there's a question from Abhay from Mumbai. He says, should one book profits in mid caps and small caps now or stay invested? And let me sort of broaden that question to asking you about what kind of focus will we see, a bigger focus on mega caps this year?
The bigger focus means that they should do well, and if at least, even if they don't massively outperform, at least they should form in line, because their underperformance is quite obvious. Secondly, the flows of foreigners, if they have to come, will start with the mega caps or the financials basically. IT is also, you can call it mega cap, but IT, I think the numbers will not be good. So I think financial big guys will do well because of flows, and also because it is easy to see for any new investor that he's buying them and, for 2 years the stocks haven't done well, or maybe in one case 3 years, but generally they do well, and we know separately that fundamentally they are doing well because we have 8 quarters of earnings we can see for the last 8-12 quarters. Therefore, it is just a matter of somebody doing it and then others realizing that the move in these stocks has started. But in the small and mid cap, I would think that many mid caps will still do well. Even we think that in our fund we have, these 10 mid caps, and maybe some of them are still good, some of them are still growing better. But at a conceptual level, at a macro mid cap index level, I think it is too much. So if somebody has mid cap funds being a dominant part of their portfolio, yes, they have to reduce, I think. Not much that anybody would say anything different, including the mid cap fund managers. You can see them, they have stopped flows into their own funds. You see brokers removing mid cap from their model portfolios. But as a fund, we are not able to eliminate completely every mid cap just because I come here and say that mid caps are overdone, because in a fund you can't move around so much so easily. And therefore, you believe, hopefully, that in your own mid cap there is some angle which is better than a regular mid cap index or the mid cap.
Fair enough. That's a sane advice there. But Samir, there are other pockets also that did exceedingly well in 2023. Sectors like PSUs, for example, and when we break it down to defense, railways, PSU banks, I mean, the story was stunning. But do you think that now is the time that one should book out from these particular pockets?
There, I would think that they might still do well. Because they started very cheap, so somebody can still justify them. We own only the old State Bank from the banks which we had from 2020 June, so that one played. We don't have any other PSU banks. But for us, the other one which worked was Bharat Electronics, which also we held for around 2 years. And then HPCL worked big time for me. But other we didn't have because we were not really PSU type guys in our life. But the last one we bought about 4-5 months ago is IRCTC. So these are the 4-5 we own. Broadly, I would think that PSU still might do better than mid caps and small caps because there there might be some changes that are happening. The environment is helping. It is clear that government has become more favorable. For example, this rule that the government rule not necessarily favorable, but it is helpful for the stock is to say that you have to pay out 30% dividend. Now, all these guys were trading at, in those days, 5-6p. So, which means if 30% dividend on those numbers, that was a big number. Previously, you could see these earnings, but there was no next thing that somebody will give them to you. So, in these oil companies, for example, if the P's are 4 and 5, and then you say, which means 20% earning yield, and you say that 30% will be dividend payout literally compulsory, then you are getting 7, 8, 6, 7, 8% dividend yield, which is not bad for being able to see that these earnings are real. So I think they are okay. Not overweight, but they are good. They are okay, all these stocks.
Samir, to continue with this point, given that the first half of the year, including the upcoming budget, there are certain sort of expectations, but would the reaction on the reform side, including more disinvestment and perhaps braver disinvestment like Air India, happen in the second half of the year post the election result, and would that therefore buttress the PSU stock theme?
That is one of the stories, that there will be some reforms or strategic sales for sure. This budget is only for your television channels. There is no budget on Feb 1 that anybody is going to wait with bated breath for, I think.
But we'll still get you that day as well.
I am not there. I'm in US that time. So, but I think that is part of the story for PSUs. That there will be some action, some merger, some consolidation. That I think is part of the story. Otherwise, there's no story in the sense that what is the new thing that you can do for these companies as a government or as an owner, majority owner, is that you give them more freedom and you make it more institutional.
Perhaps an outright sale in 2-3 companies at least?
Possible. For example, Container Corporation was always on the line. In the BPHP time, you could bring in some, they were always on the line. And then it didn't happen, and so you could bring in either a partner or, for example, in HPCL, they are spinning off the lubricant business. So you could just be a bit more active and more willing to unlock value because the Department of Government, whatever, privatization or the PMO or whoever or your ministry is more willing and encouraging you to do things which creates earnings and value.
Samir, one quick follow-up, and Sakshi tracks this space. What really is this defense theme? Because a lot of people keep talking about defense stocks, and while there might be pockets of excellence, but overall in scale terms, I think there is still a long way to go.
Yeah. But we bought one stock on the basis that who knows whether you'll ever make a submarine or a fighter jet squadron, and they take 10 years. But you will keep needing electronics for everything. So we said it's easier to buy Bharat Electronics. But the big picture theme actually has been a big picture theme for 2 years in the world. World means everywhere the defense stocks have been doing well. First because of this Russia, Ukraine, and then whatever. And before that, generally the feeling that because of China and all, that whenever there's a crisis, you stop export of sensitive technology, of defense equipment and all that. And from an India point of view, it was easy to start the Make in India by saying, it is difficult to tell some company make something for export, but it's easy to tell them that I already import these things and these things are very easy to make. So you make them and I'll buy from you. That was nearly 100% in government's control, that anyway I'm importing these things and some of them look easy to make in India, so we will encourage it. Therefore, it had a higher probability of working. Unlike some new thing, if you say, are we going to export chips? Now, nobody knows when you will make, who will buy and all that. Here, it was easy to do. And therefore, that theme has worked. Now, every small company getting every 100 rupee crore order, that are the thing which our market is doing, which is what looks too much. where any company doing, I make one, I don't know, whatever small thing where the total sales have been 100 and 200 crores. Somebody brings in these Chinese drones I am making, and therefore it will be used by the army, and the IPO opens, the IPO happens at 10 times higher price than the last funding 9, 10 months ago. I mean, these things are the excesses, which it's nearly guaranteed that in the end they'll go back 50, 60, 80%, if not almost.
Right. So, Samir, I'm glad that you pointed out on IPOs, and the next question from our viewers is on the IPOs as well. From Nagpur, Dhruv wants to know, will investors make more money in IPOs in 2024 or in secondary markets? What would you advise?
Oh, no, they will always make more in secondary markets, because very simply because you don't get allocations in very good IPOs. So the thing is that if you have 100 rupees and you keep waiting for IPOs, and in that IPO you get 20 rupee allocation, and that 20 rupee these days doesn't even double. These days it's going up 30%. So you make 5 rupees, let's say. And so therefore you're waiting with your 100 rupees, which over time anyway will make you 15, 20 rupees in a year. For example, just in December, the market went up some 8, 9%, right? So that means on your 100 rupees, you would have made 9% anyway in 1 month. In that month, because it was hot from the stock market, it was hot for the IPO also. But in the IPOs, 90% of them would not have got even one allocation. So you will get IPOs of stocks where nobody wants. In the end, you would have, for the next IPO, not realizing that not realizing that suddenly if one IPO will fail, you will put in a big bid on the basis that the allocations are always small, and then you will suddenly get much more. This is what happens every time. It's not in India, everywhere in the world. But more importantly, please ask for examples where somebody makes money buying on day one of the listing. That is even easier, that maybe 5% of the people make money. So if you think that the day one guy never makes money, why do you think that you will be able to sell at that price? Once in a while you're able to do because of speculation. But if people who buy on day one of the listing can't make money, and that proof is black and white, then why does the IPO go from 50 to 100, and then at 100 nobody can make money? But it is happening these days for whatever reason. And that is why this cannot last. And in any case, over a year, you're not making really, I think, as much money as just being invested, because of not getting the allocation in the IPOs that end up doing well.
Samir, I want to get you to speak about something that you have said for long, but this is a question because of the fact that there are so many new entrants in the markets, and they are the ones who perhaps want and need expert advice. And this is elimination investing.
Yeah.
And viewers, some of the key points of that are coming up on your screen, but essentially investing in intervals of 1 to 3 years. Please expand on that theme. What really is elimination investing?
So what I was saying, no, so this one is not elimination. This is the time frame, whatever part of that. So the idea is that it is very difficult for you to find 20-year winners and 10-year winners. So you look, because A, it is very difficult to see that long. Second, the number of stocks that do well for 20 years is very limited. For example, Mr. Buffett wrote in his last letter, that is for 2022, that his whatever, some word, reasonable, well, obviously is much better than reasonable, but his reasonable success or whatever has come from about 12 successful decisions in his life. And these are his words or something like that, more or less one every 5 to 6 years. That means he gets a big winner once in 5 years. So how can you get them with every trade that you do? Because he's looking for a 20-year winner. I'm saying don't go for 20-year winners, because you will not be able to get them so easily. You look at a stock with a 2-3 year view. In a 2-3 year view, what happens? That your ability to see the future is there, because it's the same management, it's the same environment, it's the valuations are what they are. There is a preference of the market, there is policy, which is more relevant to today. And then if that stock does well, you hold it for 2 more years, and then you hold it for 2 more years, like I have done with HDFC Bank. But you never go in thinking that I bought this stock with a 20-year view, and therefore I will not care in between what happened. If you look at Rakesh Jhunjhunwala, for example. Now, he did not start by saying, I am buying Titan and that is the end of my story. He would have bought 100 stocks. The ones which worked, he kept. The ones which didn't work, over time, giving them 1-2 year period, he let them go. For example, Mr. Buffett, who has made a lot of money on Apple, but in the beginning, he bought a similar amount of IBM. He bought 10 billion of IBM and in the beginning bought, I think, 7-8 billion of Apple. Then he's bought more Apple. But where is that IBM? It doesn't exist because he sold it off because it didn't work. Therefore, your idea is you go in with a 2-3 year view and thinking that it's good. And if it is good and does well in those 3 years, you hold it. But don't go in thinking I found a 20-year story, because as soon as you say you found a 20-year story, two things happen. You stop worrying about the valuation, saying, my story is so big that I don't care for starting valuations. And second is you give it too much time. No. My view is 10 years. How can I look at a stock within 4 years? No, please look at it over a 1 to 3 year period. And if it doesn't work, be serious about either rejecting it or throwing it out, or having some belief that, it didn't work, but it is working otherwise, in the sense that you still know something more about it. That is what we mean by keep a 2-3 year horizon. Don't be embarrassed, like our fund managers are embarrassed that if they say 2-3 year, people will look at them as traders or something.
Yeah, so don't be embarrassed. Wise advice over there. And you also talked about HDFC Bank, which is your top holding again. It's not worked at all in this 2023, not even in 2022.
22.
And I remember.
21. Not even in 21. But our portfolio has worked, so we are okay.
So and you also mentioned that, I think you sang a song or something, Kya Hua Tera Wada for HDFC Bank once before, I remember. What
But
would
by
you
the
say
way,
now?
it has worked all my life. I bought it in the IPO, so it would have gone up, I don't know, 1,000, 2,000 times or whatever it has gone up.
Yeah.
Taking all the splits. It has worked every time. I think it is still working in the sense, it's not that every stock I own, even if they're not doing well for 3 years. But if you can see it clearly that the earnings are coming through, and then there is some logic, okay, why it underperformed. But broadly, you feel that A, the earnings are still happening, and B, you can easily see that if you believe that foreign investors will invest, because that is part of my belief also, that they will come in with style. Because anyway they invest every year more or less, other than 3 or 4 years where they've been net sellers. But secondly, because of China. So if they put in big money, HDFC Bank and all these banks are a big part of the index. So whether you like, they can underinvest, underweight, overweight, but they'll have to buy these companies with serious money. And then once it starts, everybody will be able to say that, it's not done well for 3 years as a stock. And it is cheapest that it has been for 10 years. Rest of the market is at its high for 10 years. In the rest of the market, the earnings are growing this much, but the price appreciation is much more. And therefore, then it becomes a sort of a spiral. And we have seen that in many stocks where people feel that this is everybody's favorite, and then they say everybody hates it, and all these things change with a little bit of turn, and that is what we call halo effect. If a stock is doing well, we will be able to give you 100 points on why it is good. And if it is not well, they'll say, my app is down, I sent my money, as if anybody cares whether your money was sent on time. Once the stock moves, I will give you 27 plus points. Right now, somebody else can give me 25 negative points, all trivial.
Samir, HDFC is a behemoth. There's no doubt on that. But you see certain newer banks being far more slick when it comes to technology and how they service the customer. And HDFC, I think there's still work in progress internally. Plus the mergers. You think those overhangs will be dealt with in the near future? Because some people say that it's such a behemoth that it's finding it difficult to adapt in certain aspects.
We understand the positioning in our portfolio. Our number one holding does not mean highest expected return. We have two kinds of stocks in our portfolio. One is what we call high confidence in reasonable return. That means the confidence is very high, but since the stock is well known, it is big, you're not going to get 35% per annum kind of return. But the thing is also that when the market falls, it will not fall 35%. The second group is reasonable confidence in high return, where all these Zomatos and Paytms come, that if it works, we'll make 30% or 25% or whatever we make, and maybe in smaller bank, which also we own, like IndusInd and all. But these are different buckets in a portfolio. One which will not embarrass you in bad days. It will hopefully outperform the market by a few percentage points, and it is like the backbone. Every stock is not something that will rocket next day, because we have seen when if things change, they also fall 50%. So you have to have a combo of the two. Some are the steady compounding type, but not compounding at 30%, but at maybe 18% if the market is growing 15%, and that would be the positioning for these big names.
Fair enough. Samir, so in the end, tell us, what is your New Year resolution for 2024?
I have no New Year resolution because I'm a reformed individual. All the resolutions that people make for New Year, I'm already doing, which is walking every day, gym nearly every day, and no sweets or very limited sweets, no gulab jamun also these days. Now, what more can I have? Books I read. So I'm okay. If I can continue with this, that is my resolution.
Samir, one of my colleagues has asked me to request you to say, your advice for investors, for our Hindi audience. I'm not asking you a specific question, but a broader point for our Hindi audience on BT Bazaar, where a significant number of people also follow you.
तो जी इसमें तो बड़ा आसान काम है कि अगर आप रिसर्च करें तो आपको पता लगेगा कि स्टॉक मार्केट या इक्विटी के रिटर्न्स आपके बाकी ऑल्टरनेटिव जो अगर आप बैंक में रखें, फिक्स्ड डिपॉजिट रखें, डेट म्यूचुअल फंड, प्रॉपर्टी, गोल्ड, उन सब से हायर होते हैं. इसके लिए कोई डीप रिसर्च नहीं चाहिए. 100 साल का डेटा तो आप गूगल पे भी ढूंढ सकते हैं. जिन कंट्रीज का 100 साल का डेटा है, जो मोस्टली यूएस एंड यूरोप, कि हर 10 ईयर पीरियड में इक्विटी मार्केट्स ने बॉन्ड मार्केट्स को, मतलब फिक्स्ड इनकम मार्केट को करीब 5-6% पर एनम से बीट किया है. इसमें कोई रिसर्च करने की जरूरत नहीं है. इसमें आप कम पैसे भी डाल सकते हैं, टैक्स भी कम होता है इक्विटीज में. सो और हमारा फंड भी है आजकल तो.
बट सोने का
जब
क्या होगा?
नहीं भी था फंड, जब हमारा फंड नहीं था 20 सालों से, उस वक्त हम यही बात करते थे.
नहीं, कुछ लोग थोड़ा नर्वस हैं समीर जी, मार्केट की वैल्यूएशंस को देख के, और कह रहे हैं कि थोड़ा निकाल के सोने में रख लो, क्या पता क्या होने वाला है.
वो थोड़ा बहुत किसी को करना तो मैं मना नहीं करता हूँ, क्योंकि कोई जरूरत नहीं है कि आदमी को इतना ओवर इन्वेस्ट हो जाए कि उसको रात को नींद ना आए. बट जनरली ओवर टाइम, अगर आप 2007 के एंड में भी आए होते, आप 1999 के एंड में भी आए होते, लेकिन एक बार ही नहीं कि एक बार सारे पैसे डाल दिए, फिर आप कह सकते हो मेरा तो गलत हो गया. लेकिन अगर आप हर महीने डाल रहे हो, 2 महीने डाल रहे हो, आप करके देख लो अपने किसी भी एसआईपी कैलकुलेटर वगैरह में, स्टार्टिंग डेट दिसंबर 2007, जिसके इमीडिएटली एक साल में 50-60 मार्केट% गिर गई. लेकिन आपने सारे पैसे अगर एक दिन डालने हैं और उसके बाद कभी नहीं डाले, तो आपके 4-5 साल वेस्ट हो गए. लेकिन आपने सपोज 30% फर्स्ट डे डाल दिए और फिर हर 3 महीने में 5% भी डाले, तो आप देख लीजिए रिटर्न अपने आप सब कवर हो जाता है. बिकॉज जब वो मार्केट गिरती है, उस वक्त जो एवरेजिंग होती है उसका भी तो मल्टीप्लायर होता है, क्योंकि ओरिजिनल प्राइस आपको वापस मिलनी है. जो भी इंडेक्स था, आप देखो 2007 दिसंबर में, उसके बाद जब वो गिरेगा तो आप उसमें और तो डालेंगे ना. तो इसलिए वो प्रिसाइज टाइमिंग नहीं हो सकती. लेकिन अगर किसी को 10% निकालने, वो निकाल लो. बट जनरली कहने का मतलब है कि इक्विटी से बेटर कोई वो नहीं है. लेकिन अपने आप को मैनेज करने के लिए हम भी शॉर्ट करते हैं, कभी 5% कैश होता है. वो इसलिए होता है टू हैव बिलीव कि हमारा कंट्रोल है, कि अगर मार्केट गिर रही है, नो प्रॉब्लम, मेरे पास तो 5% कैश है, वो मैं भी लगाऊंगा. अगर आप पूरा लगा दो तो फिर आप रोज में खाली भगवान का नाम लोगे, वो भी लेना चाहिए. लेकिन कुछ अपना वो होना चाहिए कि हम ये करेंगे उस दिन. सो इट्स ओके. बट जनरली आप इक्विटी को बीट नहीं कर सकते. आप जो मर्जी कर लो,
जो मर्जी कर लो. समीर अरोरा, फैंटास्टिक स्टार्ट on the market coverage here on Market Today, Business Today Television and BT Bazaar with you. Couldn't have been better. Thank you very much for your time. And viewers, with that, it's a wrap on this wonderful conversation with Samir Arora. We'll be back with more. Until then, goodbye.
thank you.